Now we'll be looking at the profitability ratios. Profitability is measured in two aspects. One is with respect to sales, another is with respect to assets. Now when it is measured in comparison with sales, it is called return on sales ratios. And when it is measured with respect to assets, it is called return on asset ratios, or it is called return on investment ratios. So first let us look at the return on sales ratios. So here we have the return on sales ratios, friends. First comes the gross profit margin. This is basically sales minus cost of goods sold divided by sales. Sales minus cost of goods sold divided by sales. Preferably, a high gross profit margin is good and is indicative that the business is capable of charging the client a good amount of margin over the cost of goods sold. Then comes the operating profit margin. The operating profit margin is basically the gross income minus the operating expenses divided by sales. A healthy operating margin basically indicates that the operating expenses are being efficiently utilized. So this also has to be a high number preferably. A few more things. A decreasing trend in the gross profit margin indicates that the raw material costs or the cost of goods sold is on the increase and the business is not able to pass on the prices to the customer. And the reverse is true if the gross margin keeps on increasing. That means there is reduction in the price of raw materials. The business has been increasing its pricing power gradually. In case of operating profit margin, an increasing trend means the operating efficiency of the company is increasing, obviously it's improving, and the reverse is true if the trend is going downwards. Pretax margin. Pretax margin is basically the operating margin minus the financial expenses divided by sales. Operating margin minus financial expenses divided by sales. Obviously, a lot of difference between the pre-tax margin and the operating margin means the interest is high, which is not desirable at all. An ideal case is that the operating margin is very close to the pre-tax margin, which will mean that the interest payments are not that high. An increasing trend in the pre-tax margin would mean that the interest burden is getting reduced, and a decreasing trend means the company is taking on liabilities, which is basically financial leverage, which is not very efficient. Net profit margin. Net profit margin is basically pre-tax income, that is profit before tax, minus tax divided by sales. This basically means it is sales minus all expenses divided by sales. So obviously, taking into account all the expenses, if the net margin is still healthy, that is a very good sign. Sometimes it so happens many companies have a great gross margin or a great operating margin, but after you come to the net income, the numbers dwindle. That is not desirable. Ideally, you would want a high net income by sales ratio. This is basically the net profit margin. So PBT minus taxes is basically the net income, and similarly sales minus all expenses is also net income, and this margin is basically net income by sales. Now we will get into the return on investment ratios. Return on investment ratios. Now these are basically comparison of the profits with respect to the assets. Now the first one is operating return on assets. This is basically operating income divided by average total assets. Obviously, this number is desired as to be high. Return on assets, this is basically net income divided by average total assets. Now there is a problem, friends, with this. We are measuring the earnings based on total assets, but total assets includes both debt and equity. But net income only goes to the equity holders because interest is deducted from this. So to avoid this paradox, there is another way of measuring this. This is basically net income plus tax adjusted interest total assets. Another more straightforward way is to divide the earnings before interest and taxes by average total assets. So these are the three options. Return on capital employed. This is earnings before interest and taxes divided by interest bearing debt or interest bearing the liability plus average total equity. Interest bearing debt plus average total equity. This basically means short term interest bearing debt and long term interest bearing debt, and this is the average total equity. So this number is also preferred to be high. Return on equity. Return on equity is basically net income divided by average total equity. This is total equity means all kinds of equity categories added together. So this also, if the debt is low, a high ROA is very good sign. Similarly, a high ROE can be achieved by taking lots of financial leverage, which may be counterproductive. Return on common equity is basically defined as net income minus preferred dividends divided by average total common equity. So we are taking only the common equity into account here. And this number is also desired to be high, provided the debt is low. So that's about it for the profitability ratios. Next, we'll move on to the Dupont analysis. So friends, we will now witness something called the Dupont analysis, which is basically decomposition of the return on equity into various subcomponents. It's a beautiful decomposition which lets us know how return on equity is influenced by multiple financial parameters. So return on equity, as we already know the definition, friends, it's net income by average total equity. Now we can tweak it just a little bit. Let's say we incorporate average total assets here. Average total assets. Now, because we have incorporated this in the denominator, we also introduce in the same in the numerator, so that the ratio remains unchanged in actuality. Average total assets divided by average total equity. But see friends, a curious thing has already happened. Net income by average total assets is basically return on assets, right? This is return on assets. And this one, average total assets by average total equity, is actually financial leverage. So you can say return on equity is the product of return on assets and financial leverage. But that is not the end. We can decompose it further. Let us do it. Like we incorporated average total assets, now what we'll do is we will incorporate another parameter, which is revenue. So net income by sales multiplied by sales by average total assets multiplied by average total assets divided by average total equity. Again, a very interesting equation has developed. You see, friends, net income by sales is basically net margin. So this is net profit margin. Sales by average total assets is basically turnover on assets. Turnover on total assets. And obviously, average total assets by average total equity is financial leverage. So we can actually say that return on equity is the product of net profit margin with turnover on total assets with financial leverage. Right? Just like before we saw, return on equity can be expressed as the product of return on assets and financial leverage. We can decompose it even further. Now we'll be incorporating two more factors. Net income divided by earnings before interest and taxes multiplied by net income divided by earnings before taxes. Now we have introduced earnings before taxes, but we'll introduce one more factor, which is earnings before taxes divided by earnings before interest and taxes multiplied by earnings before interest and taxes divided by sales multiplied by sales divided by average total assets multiplied by average total assets divided by average total equity. Right? So we have added two new parameters, earnings before taxes and earnings before interest and taxes. Now these signify two new parameters here. In fact, three new parameters. What are they? Net income by earnings before tax. This basically tells you how much of a tax burden there is, right? So we write here tax burden. Earnings before tax divided by earnings before interest and taxes. This actually gives you the interest burden. This is a measure of the interest burden. So we write here interest burden. EBIT by sales obviously is EBIT margin. Sales by average total assets is turnover on total assets. And the last one, average total assets divided by average total equity, is financial leverage. So this is the ultimate decomposition of return on equity, which can be expressed as the product of tax burden, interest burden, EBIT margin, turnover on total assets, and financial leverage. This is the final Dupont equation for return on equity. Now, what does this signify? If the NI is higher, with keeping the earnings before tax constant, then the ROE will increase. That means lesser the tax burden, more the ROE. EBT by EBIT. Here also, if the ratio is higher, ROE is higher, so interest burden has to be lesser for ROE to be higher. EBIT margin. The higher the EBIT margin, the higher this EBIT number, that is the higher EBIT margin, the higher is the return on equity. Sales turnover on assets. So turnover on assets, the higher it is, the higher the ROE. Leverage. Leverage also, the higher the financial leverage, the more positive the impact on ROE is, figuratively speaking, but actually in actual cases it might be counterproductive because higher interest payments might not be such a good thing in terms of stabilizing growth, and in fact it can create huge amount of pressure and losses to the company. Friends, now we move on to the valuation ratios. So here are 4 valuation ratios for you. We will go and explain them one by one. PE ratio, that is price to earnings ratio. PB ratio, that is price to book value ratio. PS ratio, price to sales ratio, and PCF ratio, which is price to cash flow ratio. Let's first talk about the PE ratio. PE ratio, as we know, is the ratio between per share price and per share earnings. It expresses how many times $1 of earnings is being priced by the market. Let's say the PE of a company is 25. This means $1 of earnings is being priced at $25 of value by the market. PB ratio. PB ratio is basically per share price divided by book value per share. This tends to indicate whether a company is going to earn more than its cost of equity. This means basically if the company is going to earn more than its cost of equity, the book value will be generally greater than 1. If it is less than 1, this means the market thinks that the company is going to earn less than the cost of equity. Price to sales ratio. This can be used for, let's say, price to sales per share. So this is used in cases where cash flow does not seem to be there. Very fresh companies which are growing, for them this is appropriate. And for comparing between companies which do not have parity in terms of cash flows and earnings, this ratio can be used. But generally we avoid these kind of matrices because they are very superficial in nature. Price to cash flow ratio. Earnings quality, generally there can be multiple cases where the earnings quality is not up to the mark, or basically you will see a lot of disparity between the earnings trajectory and the cash flow trajectory. In that case, just to be clear in the valuation terms, the price to cash flow ratio is a better ratio to choose. That is price per share divided by cash flow per share. Price per share divided by cash flow per share. This is a much cleaner ratio than PE ratio, especially when the earnings quality is questionable. Now we have used a few terms which are basically per share quantities, right? We are going to break them down in this segment. So first we talk about basic EPS. Basic EPS is basically net income minus preferred dividends divided by the weighted average number of ordinary outstanding shares. So this is basically the EPS when none of the potentially convertible securities are converted to equity. Now what if the potentially convertible equities, like let's say convertible debt, warrants, certain options, these things are exercised, that is they are either converted or exercised, this will have a dilutive effect on the earnings. Why? Because the weighted average number of shares will increase. So diluted EPS is basically net income adjusted for the dilutive impact of securities which are potentially exercisable with a dilutive effect on the total number of shares divided by the weighted average number of ordinary outstanding shares after all the potentially dilutive securities have been exercised. So this is net income adjusted for the dilutive impact of potentially dilutive securities. Like convertible debt, like warrants, like options, potentially dilutive securities. This divided by weighted average number of shares, considering or assuming that all the potentially dilutive securities have been exercised and the dilutive impact is effective. So weighted average number of shares, assuming all potentially dilutive securities have been exercised. So again, diluted EPS is the ratio of net income adjusted for the dilutive impact of potentially dilutive securities divided by the weighted average number of shares, assuming all potentially dilutive securities have been exercised and are effective in their dilutive effect. Okay. Now cash flow per share. Cash flow per share is nothing but cash flow from operations divided by weighted average number of shares. Weighted average number of shares, or weighted average number of outstanding ordinary shares. Outstanding ordinary shares. Here also it is actually weighted average number of outstanding ordinary shares, EBITDA per share. This is earnings before tax, depreciation and amortization. So EBITDA by weighted average number of outstanding ordinary shares. Weighted average number of outstanding ordinary shares. This is a very useful tool when you want to consider a number which does not include the leverage impact or the impact of the changes in the fixed cost from time to time. So this metric can be used in that case when you are just looking to find out the operational performance of the company. Dividends per share. So this is dividends per share is common dividends declared divided by the weighted average number of ordinary outstanding shares. Common dividends declared divided by weighted average number of ordinary outstanding shares. So dividends basically signify what stage of growth the company can achieve in the future, or what stage of maturity the company has reached in the present. How, we will see in a while. So friends, now we will try to understand how the dividends actually let us understand what is going to be the sustained growth rate of a company, or what stage of maturity the company is in. So let's say a company earns 50 rupees per share and it releases dividends of 20 rupees per share. Now the dividend payout ratio is 20 by 50, which is 40%. So this is dividends per share divided by earnings per share. Retention ratio is basically the reverse of it. Retention means what you are not paying off as dividends, what you are retaining. So this is 1 minus dividend payout ratio. So this is sometimes denoted as B, and this one is sometimes denoted as P. So this is payout ratio P, and this is retention ratio, which is denoted by B. Now sustainable growth rate. This is basically the more it's common. If you apply common sense, the more dividends are paid out, the less the earnings are retained for future growth. Therefore, the less will be the growth of the future. So the sustainable growth rate is measured as return on equity multiplied by 1 minus the payout ratio, or which means return on equity is sustainable growth rate is return on equity multiplied by the retention ratio. So these are the matrices that let us understand. So you can understand how the dividend payout ratio lets us understand what is going to be the sustainable growth rate to a certain measurable extent. Now, if a company is very new, its dividend payout ratio will be very low. For a new company, which means the sustainable growth rate can be very high. Now, for a matured company, which has whose market is saturated and which is really looking, payout ratio will be very low for a new company, which means the sustainable growth rate can be very high. Now, for a matured company, which has whose market is saturated and which is really looking to maintain growth rate rather than maintain its position rather than grow position, that kind of a company will have a high payout ratio. Generally, this means they will have a low sustainable growth rate. ROE into B will be low. This is sometimes denoted as G also. So G will be low. Next, we will move on to industry specific matrices and ratios. So friends, now we talk about a few common industry and task specific ratios. The first 3 numbers or the 3 quantities that we start with basically comprise what is called the business risk of a company. So these are coefficient of variation of operating income, coefficient of variation of net income, and coefficient of variation of revenue. Now, how do you measure it? It's very simple. Coefficient of variation of operating income is basically the standard deviation of operating income divided by the operating income. Now, the more this number is, which means standard deviation is higher compared to the OI or the operating income, the desirable situation is this figure remains low. Same goes for the other 2 matrices also. We want the other matrices low. And how they are measured is very similar. Coefficient of variation of net income is standard deviation of net income divided by net income. We want this number also low. Coefficient of variation of revenue. This is standard deviation of revenue divided by revenue. This number also we want it to be low. And these 3, as I said, comprise what is called business risk. So these are business risk measures. Now we take a look at some of the financial sector ratios. So we are talking about industry specific ratios. This is a specific industry, which is the financial sector, and specific to this industry, there are certain ratios which are covered here. Let's see. First is the capital adequacy ratio. This is something that is required in the banking industry, and it is the ratio of different components of capital divided by the risk-weighted assets. So capital adequacy ratio is basically different components of capital like tier 1, tier 2 capital, etc. divided by the risk-weighted assets, which also can be synonymous to sometimes expressions like level of operating risk or market risk exposure are also used in the denominator. Monetary reserve requirement or cash reserve ratio. This is also concerned with the banking industry, and it is defined as the ratio between the reserves held at central bank divided by the specified deposit liabilities. So reserve held at central bank divided by specified deposit liabilities. It is desirable to have an adequate value for both these ratios, and these are regulated numbers, so obviously the financial service companies or the banks have to maintain a minimal ratio to be validated, and central banks are always observing them. Next comes liquid asset requirement ratio. This is the ratio between approved readily marketable securities divided by specified deposit liabilities. So approved means approved by the regulators. Net interest margin. Net interest margin is basically net interest income divided by total interest bearing liabilities. Net interest margin. This is the ratio between the net interest income divided by interest earning assets. Divided by interest earning assets. Now we talk about a couple of retail ratios. The first one is the same store sales. This goes like this. Let's say in period 1, one of the stores gives a revenue of 50 million. In the next period 2, it gives a sales of 54 million. Now the same store sales figure will be 8%. That is the increment from 50 to 54. Whatever that growth rate is, that is basically the same store sales growth. Sales per square meter. This is the ratio between the total sales divided by the total retail space in terms of square meter. These are the two retail ratios. Then comes service industry ratios. The first one is revenue per employee. Revenue per employee. The first one is revenue per employee. This is basically the total sales divided by the number of employees. Number of employees. It's very simple. Net income per employee, simple. Net income divided by the number of employees. Now we will talk about a couple of ratios which are used in hotel industry. So hotel industry ratios. First is the occupancy rate. This means, let's say there are 50 rooms in a hotel, and out of that 35 are occupied. This means the occupancy rate is 70%. Okay, obviously we want a higher number which is desired. Average daily rate. This is basically the total revenue earned from the occupied rooms divided by the number of occupied rooms. So room revenue divided by the number of occupied rooms or number of sold rooms. Obviously we want this number also to be high. The higher the better. So that's about it for the industry level ratios. Next we'll move into credit analysis and credit related ratios. Credit ratios, selected credit ratios. Now friends, before we get into the credit ratios and their definitions, let us first understand what is credit risk, what is credit analysis, and what is credit scoring. So friends, credit risk is the risk that some person or some entity or some company which has taken up debt will not be able to repay it. This is what credit risk is. Credit analysis is basically the analysis of the credit risk. What is the degree of it? What is the loss? Expected loss? What is the expected recovery on all that? Credit scoring or credit rating is basically giving points or marks to an entity based on its performance in terms of its credit risk analysis. So how does this credit risk analysis happens? Generally, there are many parameters which are taken into account, but the ratios play a very important role, and the ratios are arranged in a sequence, and depending on whether the target entity has its performance below median or above median, a score is given. So now we will be getting into the ratios and their definitions, friends. EBITDA interest coverage. This is basically the ratio of EBITDA and interest coverage. Now this interest includes non-cash expenses on conventional debt instruments. Again, this is the ratio of EBITDA and interest coverage. This interest coverage includes non-cash interest which is paid on conventional debt instruments. Fund from operation to debt ratio. This is basically fund from operation divided by total debt. So what is funds from operation, friends? Funds from operations is basically net income plus depreciation and amortization plus any loss on sale of assets minus any gain on sale of assets minus net interest income, if any. It can also be defined as EBITDA minus interest minus taxes plus minus additional adjustments. So these two are the ways in which we can define funds from operations. Obviously, FFO to debt, we want this number to be high, right? We want this number to be high. Similarly, EBITDA to interest coverage, we want this number also to be high. Free operating cash flow to debt ratio. This is cash flow from operations with the right adjustments divided by total debt. We want this number obviously high. EBIT margin. EBIT margin is very simple, friends. EBIT divided by sales or revenue. What do we want this number to be, guys? We want this number to be high, obviously. EBITDA margin is EBITDA, that is earnings before interest, tax and depreciation amortization. EBITDA divided by sales or revenue. Debt to EBITDA. This is equal to total debt divided by EBITDA. Of course, we want this number to be as low as possible. This number we want high, this number we want high. Return on capital. Return on capital is basically earnings before interest and taxes divided by capital. Capital is, let's say, what is capital? Capital is equal to debt plus non-current deferred taxes plus equity. This is basically capital, average capital, or capital at the beginning of the year, capital at the end of the year divided by 2. This is basically average capital. So obviously we want this number also to be high. So these are the credit analysis ratios, friends. Friends, Altman and Altman, Haldeman and Narayanan found out that financial ratios could be combined to create models that predict bankruptcies in a very accurate way. financial ratios can be combined to create models that predict bankruptcies very accurately. And based on this, Altman created something called the Z-score. Now Z-score includes a few ratios which goes like this. Z-score equal to 1.2 into the ratio of current asset minus current liabilities by total assets plus 1.4 multiplied by the ratio of retained earnings by total assets plus 3.3 into EBIT by total assets plus 0.6 into market value of stocks divided by book value of liabilities plus 1 into sales divided by total assets. This was Altman Z-score, and he proved up to 95% accuracy that a score of less than 1.81, that is Z-score less than 1.81, implies bankruptcy. That is, a company might soon go into bankruptcies. A segment of a business is defined as a portion of a business that can generate both sales and expenses, and this includes non-sales generating startups, that is regularly reviewed by the management, that is in terms of the results, and that is separately available, that is discrete financial data is available for that. So this is what a segment means. Now if a business has a segment, there are certain mandates which have to be reported regarding the segment. We will come to that now. So a segment which can be defined as a valid segment has the following reporting requirements, ideally. Number A is profit and loss for that segment. There has to be a measurement way to measure it. There has to be a way to measure the assets and liabilities related to that segment. Segment revenue, both to external customers and to internal other segments, mentioned separately. Interest, both earned and paid. Cost of property, plant and equipment and intangibles purchased. Measure of depreciation and amortization. Measure of other non-cash expenses. Share of net profit and loss of an investment accounted for under equity method. So share of any investment that is accounted for in terms of profit and loss for this segment under equity method, that has to be mentioned or expressed or declared. Tax pertaining to the segment, both in terms of tax expense and tax income. So these are the reporting requirements ideally. Now we will come to the segment ratios. Segment ratios. First is segment margin. This is obviously segment net income divided by segment sales or segment revenue. You want this number low or high? Obviously high. Segment turnover. This means segment sales by segment assets. Obviously you want this number to be high. Segment return on assets. Obviously segment net income by segment assets. You want this number also to be high. Segment debt ratio. This is segment liabilities by segment assets. Obviously this one you want to be low. So friends, that's about it from the financial analysis techniques and ratio analysis chapter. We will meet you in the next chapter. Till then, keep studying and subscribe to the channel for more videos, more classes, Enroll to the CFA curriculums that are being provided for Level 1 and Level 2. In our program, for those who enroll, we will be doing counseling sessions one-on-one. We will be doing doubt clearing sessions for every classes and every problem that you face. You will be handed over the entire curriculum over a period of 4 to 6 months, where periodic counseling and frequent weekly doubt clearing sessions will happen. And there will be ample sets of practice problems which you can practice throughout the months leading up to the exam. You can check out the website given in the description below and enroll for the program. Till then, subscribe to the channel. Classes will keep coming in this channel, full classes, and you can attend to them. You can also attend to the topic-wise classes that will be uploaded in this same channel. Thank you, friends.